So I'm going to talk about in this video, I want to expand more on the first video that I did with tax-free retirement in this series, that the more recent ones, talking about the more accessible premium finance situation. So a few things I wanted to point out is, one, for those who qualify for this, and this is, like I said, this is a lot more accessible because the other premium finance strategies are for high net worth individuals. This one doesn't necessarily, you don't necessarily have to be high net worth. You just have to have a good household income, which is, like I say, very attainable because it's over $100,000 a year in household income. So that means, husband and wife can qualify for at least one of these retirement plans. And, if their income goes up from there, maybe they both have higher incomes, maybe they each make $100,000 and above, they might qualify for one for each of them. But this highly leverages your possibilities. Let's compare it to if you had, let's just say, $150,000 in cash. Do most people go out and buy a house cash? No. What they'll normally do is they'll take the $150,000 and put it down as a 20% down payment. So they end up buying a much bigger home. And it's because they want the bigger home. They want the nicer home. Most likely they have a family and whatnot. And depending on the area you live in, $150,000 house may not even be possible. That may not even buy you a house. So, and especially in today's real estate market, which is pretty crazy depending on your state. And I think most states are seeing an increase, but particularly, certain states such as Texas and Florida, and I believe even New Jersey and a few others, they're having, massive growth because there's a lot of people who are coming from New York or California for other reasons. But in this case, you look at it as if you were to put 20% down, and let's just say it was $100,000. I mean, or for sake of easier numbers, you want to buy a $500,000 house and you're putting 20% down, right? Well, why not? You put $100,000 down and you get a much nicer house. Yes, you have payments in this scenario, but the difference is in this approach with the retirement and this particular strategy, you actually don't have any payments. The payment comes from the cash value that you build up in this policy. So it will, and then you'll be paying in for only 5 years on your portion, but it gets paid in as 10 years. So there again, if you pay in, just say, for example, and these might not be the exact numbers, but say it's $25,000 a year you pay in for 5 years, it's $125,000 you paid in. But they're paying in additional $75,000 for an example, depending on how the numbers work, age, stuff like that. But usually it's somewhere in that vicinity. And you're paying roughly 25 to 30% of the amount for those 5 years. So let's just say it's 25%. We'll make it easy. So you paid $125,000 in. Well, every year $100,000 was going in, right? So now you paid in a total of $500,000, and actually $1 million will be the total that goes in over 10 years because you'll have no contribution whatsoever. You don't have to, and in this scenario, you don't have to sign for a loan. You don't have to, have collateral or anything like that. There just have to be certain qualifications in place. You don't even have to have a credit check or anything, really. And some of that might depend on the lender, but this specific strategy, it's not likely. I'm not saying it can't happen, but it's not likely. So the sole actual collateral for this situation is the actual policy. And it'll be capitalized until up to 10 years, and then you'll be sitting on it and letting it grow for another 5. And then after those 5 years, so total of 15, so look at it as a retirement plan, just as what I'm saying, but it's going to be tax free. So any money you receive is by way of, well, let's not get into that, but any money you receive in this scenario done correctly is going to be free of taxes. So with that, you are able to realize all of the income instead of only realizing that income minus taxes. It's much more powerful in the way that you've already been potentially taxed on any money that you contributed, and the rest of it was a loan to begin with. So loans aren't taxable. So in this case, from the lender. So if you do this, it gives you, it's so much more powerful. It gives you a higher income later on in life. And the awesome thing is in this scenario, if you wanted to, if you were worried about, let's just say you were worried about insurability in 5 years, we can get you a term policy as well, which will be typically inexpensive enough. We'll get you a term policy as well, and on the side, and make it to where it's convertible into one of these policies, right? So if it's convertible into one of these policies, then you don't have to worry about going through underwriting again because it'll let you convert it. And so your insurability isn't a problem anymore. And this is done with the proper companies and the proper type of policy, because there's different types. But for example, if you had a non-convertible one, then that would only provide the protection of death benefit. But in this case, it would provide the protection of death benefit until you converted it, and then it would also have the cash value growth potential. So it's a pretty amazing way of doing things. You know, there again, I come back to, you can put your $6,000 a year into your IRA, but your income is not going to be just a lot of money on the backside. Plus, you've got to look at fees, and you got to look at fees, commissions, which is kind of the same, and you're looking at taxes. So with these numbers that we run, whenever we run these retirement plans for you, with this premium finance, the numbers are going to be ideally, I won't say ideally, it's going to be after expenses is what you're looking at potentially. And we run, these scenarios. We try to run them conservatively because there's also a performance factor in there of everything. But hopefully what we're looking at is, because it's looking like, even though they say there's no inflation, it's looking like inflation is happening. With the inflation going up, what happens, consequently, is that interest rates go up. And when interest rates go up, bond rates go up, different things go up, one. And then two, these particular policies are structured differently. But the nice thing is that since you can't lose money in these policies, you always have that upside, with that being said. But if you're interested, again, and you want to take a look at it, and you fit some of these general guidelines, we can sit down, take a look at it. We'll do you can schedule a strategy session with me down below, link down below. We'll go through some examples. I'll show you what is possible, and then you can give me an idea of what you have in mind that you want to see in retirement. And then we'll model it, we'll reverse engineer it to where we can make it fit to your needs. Because there are some people who want to put more than, 20 or 25,000, say $25,000 a year. Some people might might be able to afford to put $100,000 a year for 5 years. All of this is, are doable scenarios. There is a limit, but for the most part, even some of the higher net worth individuals can do this too. So it's something to consider. I think it's an amazing way to do it. It's working for clients now. And, there's some clients that do more than one. Just like I said, and you don't have to do this second term policy if you're generally healthy and you're going to be insurable. But these strategies really work for young. I mean, they work for young or old, or, most people, 50-ish, looking to take retirement somewhere around, between 65 and 70, for example. This can still work and work beautifully. As long as, you're able to wait the 15 years, it's not a problem. And there again, if you're, say, 25, this works out even better because the contributions are so much lower. And in comparison, and or even then, let's just say you put the $20,000 a year, $25,000 a year, whatever the case may be, whatever you get approved for. There is typically a minimum, but let's just say you're putting $25,000 a year at the $125,000 a year mark, where if you were 45 or 50, that might get you a $60,000 a year, $50,000 a year income at 65. Pretty good still, because none of this is, you're basing that off of $125,000 in your contribution. So, that's an amazing return, especially if you're looking at, say, 20 years at $60,000, for example. But if you had that same scenario when you were 25 or 30, you might be looking at $100,000 plus in income from just that contribution at that time, and then letting it grow. So things to consider, everybody's got their ideas or thought process on, how they want to do retirement. I think this is an awesome way to leverage your retirement. If you would do it with a house, why not do it this way? And it doesn't require any additional payments out of pocket. It pays from the policy's cash value, at the end of year 15. And you still have a lot of money left over. And there's enough money for you to be able to take retirement from, and much more retirement than if you would just shove that into, an IRA with, which you couldn't, because you couldn't put $25,000 a year unless it was maybe a SEP. So anyway, even if you could do that and you just put it over there, you're looking at just the growth on that $125,000 over that 5-year period that you paid in, and maybe you didn't pay anything else in. It'll grow and it'll still probably look decent. But there again, you have to look at fees, you have to look at taxes, and then you're looking at the leverage that you didn't have. That leverage is huge. It's huge. If you're talking about $1 million as opposed to $125,000 by itself, big difference. So something to consider. I'm definitely big on it. I think it's an amazing way of doing things. If for some reason maybe somebody doesn't qualify for this, there's other strategies that you can do that'll utilize some of the same tools that you can still benefit from tax-free and actually quite well. So it won't be obviously with the same leverage, but it's still something to consider. So please like, subscribe, and click the notification bell. If you have any questions, put them down in the comments below. I'll try to make a video about it, especially if it's something that's a pretty extensive explanation. So I believe, like I said, I believe this is a great strategy. Have a good one.